morning. So we did an introduction on the NPV, and we also did a small question on the NPV. So I want us to do some more other questions still on the net present value. You can now check some questions on the net present value. So our first question today . So before I do our next question, I want us to write something brief about overhaul costs. We can write something brief about the overhaul costs. We can write something brief on the overhaul costs as we check some more other questions on how to compute the net present value. So generally, we can just summarize that they are capital expenditures. They are capital expenditures. They are capital expenditures which are incurred. They are capital expenditures which are incurred due to the following reasons. They are capital expenditures which are incurred due to the following reasons. Roman letter one is that in order to increase the economic life of the asset, Roman letter one, in order to increase economic life of the asset. Number two would be that in order to improve efficiency of the asset, in order to improve efficiency of the asset, in order to improve the efficiency of the asset. Roman letter three, in order to improve the quality of the output. Roman letter three will be in order to improve the quality of the output. In order to improve the quality of the output. Another paragraph, we summarize that the overhaul cost will be depreciated. The overhaul cost will be depreciated over the remaining economic life of the asset. Overhaul cost will be depreciated over the remaining economic life of the asset. To be depreciated over the remaining economic life of the asset. So we can now check a question, September 2021, question 2, part B. We can now check September 2021, question number 2, part B. September 2021, question number 2, part B. September 2021, question number 2, part B. So question 2B, it reads that, question 2B, it reads that Jahazi Limited is considering investing in the purchase of a machine for its manufacturing process at a cost of 5 million. at a cost of 5 million. Installation cost of the machine is expected to be 500,000. Installation cost of the machine is expected to be 500,000. So the machine is expected to have a useful life of 5 years, at the end of which salvage value is estimated at shillings 800,000. Salvage value is estimated at shillings 800,000. This investment shall lead to increase in the sales. In order to support increased sales, the farm will require an extra investment in the working capital at the start of the machine useful life. Inventory balances will increase by 1.2 million. Debtors balances will rise by 1.5 million, and creditors balances will increase by 1.7 million. The additional investment in the working capital will be recovered at the end of the machine useful life. So the quantity of the product to be manufactured and sold in each year are estimated as follows. So they have given you year 1 up to year 5, where we have been given the quantity. Also, additional information, note 1, unit selling price and the unit variable cost incurred are estimated at 45 and 15 respectively. These are expected to remain constant each year. Note number 2, the farm estimated fixed operating cost, excluding depreciation, are 100,000 per annum. Note number 3, the machine will require an overhaul at the end of the second year. This overhaul cost will amount to 240,000. So, overhaul cost will be amortized separately on the straight line basis over the remaining useful life of the asset. Then note number 4, the farm will provide for the depreciation on the reducing balance basis. The farm will provide for depreciation on the reducing balance basis at a rate of 32% per annum. Note number 5, cost of capital is 13%. Note number 6, corporate tax rate is 30%. So required using NPV, advice on the suitability or otherwise of the project. So there are 2 items there that need some adjustment. One of the item is depreciation as per the note number 4. Note 4, they have said that the farm will provide for depreciation or not. Reducing balance basis. So we need to get that depreciation. Then they had also given the depreciation rate as 32%. So what I will do, before I do any other working, we need to come up with the depreciation for each year. Before we assess on how to get the NPV. So to calculate the NPV, to compute the net present value, NPV is supposed to be given by present value for the cash inflows. We minus present value for the cash outflows. When you want to get the NPV, it is normally present value for the cash inflows. We subtract present value for the cash outflows. So what we need to get also, we need to get the total initial cost. So total initial cost, we start with the initial cost of the asset. You can see they say the purchase The purchase of the machine for its manufacturing process at a cost of how much? 5 million. We start with the initial cost of 5 million. Then there was installation cost. There was some installation cost. So that installation cost, they were able to give us 500,000. So remember to add the installation cost. Remember to add installation cost of 0.5 million. So this will give us a total initial cost of 5.5 million. So once we have done that, now we need to calculate depreciation. Once we have done that, we need to compute the depreciation per annum. So we shall be depreciating the 5.5 million. We shall be calculating depreciation based on the 5.5 million. So this is now how we shall come up with the figure for the depreciation. So to calculate the depreciation per annum, you want to calculate the depreciation per annum. You want to see how to calculate the depreciation per annum. So to get the depreciation per annum, we start, because it is on the reducing balance. It is on the reducing balance. So we start with the initial cost. The initial cost. So that initial cost is the one that we have just calculated as the total initial cost. That initial cost is the total that we have just calculated. So we less depreciation for year one. We less depreciation for year one. So depreciation for year one, it is simply 32% of the 5.5 million. Like that. So we simply get 32% of the 5.5 because depreciation rate was given to you in the note number 4, and it is in the reducing balance basis. So what will you get when you get 32% of 5.5 million? 1.76 million. 1.760. Like that. Yes. So you will be required to subtract that figure from the initial cost so to get a net book value. Net book value at the start of year 2. Net book value at the start of year 2. So when you net, what is the net book value at the start of year 2? 3.74. 3.74 million. Then we less depreciation. Less depreciation for year 2. So depreciation for year 2, you also get 32% of 3,740 like that. So that we come up with the depreciation for year 2. So that we get the depreciation for year 2. 1,186,000. No, 800. The last item is 800. So when you subtract, you get the net book value at the start of year 3. We get the net book value at the start of year 3. Net book value at the start of year 3. So what will be our net book value at the start of year 3? Sorry? It is 2 million. 543,200. Then we less depreciation for year 3. We less depreciation for year 3. So depreciation for year 3, you also get 32% of 2 millions of 2,543,200.
Page 24.
813. 824 like that. So when you less, we get the net book value at the start of the year 4. We get net book value at the start of year 4. Net book value at the start of year 4.
1729.
376. Then we also less depreciation for year 4. We also less depreciation for year 4. You also get 32%. 32% of 1,729,376.
553. 400.
553. So that you get the net book value. Net book value at the start of year 5. The start of year 5. We get 1 million. 100. Yeah, so when it comes to year 5, the depreciation should be the balance figure. Depreciation for year 5, we make it as a balancing figure so that we get the scrap value or the salvage value. You can still calculate, but we need to end up having the salvage value. So in the question, what are we given as the salvage value? When you check through the question, they had given you information at the end of the first paragraph. They say that the machine is expected to have a useful life of 5 years, at the end of which the salvage value is estimated to be 800,000. So we want to be left with 800 at the end of the period. So the depreciation for year 5, make it to be the balancing figure so that you get the 800,000. So that we get the 800,000. So what should be salvage value? What should be that depreciation for year 5? So that we are able to get the 800,000 as the salvage value. 375,
976.
976. Then I want you to confirm. When you take 32% multiplied by 1175,976, you will be getting which figure? So it is almost the same like what we have gotten as the difference. The difference will be very small and it will be due to the rounding off. The difference will be so small and it is because of the rounding off. That difference is how much? Okay, minus like you compare minus to talk about it. The one and the difference between the two.
336.
Yeah, so you see, you only have a difference of 3 36. Between the one you will calculate and the difference, isn't it? Yeah, so that one we assume it is due to the rounding off. Because finally, the last period, depreciation for the last period, always make sure that it should net off. So you are left with the salvage value. But when you calculate, it is almost the same. It will be just a small difference. Like now for this one, the difference is only 336, but it is because of the rounding off. So that was meant to be depreciation per annum. So this is, you indicate there, depreciation per annum on the machine. On the machine. That was depreciation per annum on the machine. There is also another item we need to depreciate. There is also another item we need to depreciate. That item, you go to the note number 3, is the overhaul costs. Overhaul is also meant to be depreciated. When you go to the note number 3, they say that the machine will require an overhaul at the end of the second year. This overhaul cost will amount to 240. And the overhaul cost will be amortized. So amortization is the same as being depreciated. Will it be amortized separately on the straight line basis over the remaining useful life of the asset? When you check in the notes we have written, about overhaul cost, they have simply said that overhaul cost is meant to be depreciated over the remaining economic life of the asset. But they have said it was incurred at the end of which year? Overhaul was incurred at the end of the second year, isn't it? So how many years are remaining to the end of year 5? How many years are remaining to the end of year 5? There are 3 years. So we depreciate it over the remaining 3 years. So let us also compute depreciation on the overhaul costs. We also need to come up with depreciation on the overhaul costs. We also need to come up with depreciation on the overhaul costs. We should be able to come up with depreciation on the overhaul costs. So to calculate depreciation on overhaul costs, depreciation on the overhaul costs. As you can see, it is 240,000. So we depreciate it over the remaining 3 years. So divide by 3 years because it was on the straight line basis. Depreciation on the overhaul, it is meant to be on the straight line basis. It is meant to be on the straight line basis. So after that, we also need to do the working. We prepare the cash flow statement to get the cash flows to be discounted. We also prepare the cash flow statement to get the cash flows to be discounted. We also prepare cash flow statements. The cash flow statement to get the cash flows to be discounted. We prepare the cash flow statement to get the cash flows to be discounted. We prepare the cash flow statement also to get the cash flows to be discounted. So there was year 1 up to year 5. So we shall be having year 1, year 2, year 3, year 4, and also year 5, like that. So we want now to get the information. So we start off with the sales revenue. We start off with the sales revenue. Start off with the sales revenue. So for the sales revenue, we start off with basically the sales. I just refer to it as the sales. So to get the value for the sales, I want you to go to the note number. I want you to go before additional information. You can see the quantity of the product to be manufactured and sold in each year are estimated to be as follows. So year one, the quantity they have given us how many units? 20,000 units. Then I want you to go to the note number one. Note one, unit selling price and the unit variable cost incurred are estimated at how much? At 45. So to get the sales for year one, I would like you to take 20,000 multiplied by 45 because the selling price per unit is 45. So take the 20,000 multiplied by 45. So that one should give us which figure? Sorry? 900. So this one will be 900. Then year two, we do the same. You take 25,000, also multiply by 45. 1 million. 1,025,000. 1,125,000. So that is now for year two. We go to year three, where you also take 30,000 multiplied by 45. Like that. We also go to year four, where you take 35,000 also multiply 45. 1575. We do the same for year five. Year five, it is 40,000 multiplied by 45. So that is now for the sales revenue. That's now meant to be the sales revenue. Then we less the variable cost. We less variable costs. We also less the figure for the variable cost. Variable cost. Variable cost will do the same. You can see in the note number one, variable cost per unit is 15. You take the same units multiplied by the variable cost per unit. Like year one, it is 20,000 multiplied by 15. 800,000. This one will be 300,000. Year two, you also do the same 25,000 multiplied by. This one is 375,000. How about year three? 450,000. How about year four? 525,000. Year five should be how much? 600. Year five is 600,000. Then I would also like you to go to the note number two. The firm's estimated fixed operating costs, excluding depreciation, are how much per annum? So it also less the fixed cost. It also less the fixed costs. So the fixed cost there is meant to be 100,000, the same every year. It is the same every year. so that we get earnings before depreciation and the tax. We get earnings before depreciation and the tax. When you subtract those two items, we now get our earnings before depreciation and the tax. So how much is there for year one?
500.
Exactly 500. So this one will be 500. Year two,
650.
year three,
800.
year four,
950.
950. Year five,
1100.
so that is meant to be our earnings before depreciation and the tax. Then now we less depreciation. We now less depreciation. We minus. So we had already calculated depreciation. Confirm year one from our workings. Depreciation for year one we pattern copy from our workings.
1760.
1760 like that. How about year two?
1196. 800.
11.
600.
Then year three.
8138.
But now the one for year three is mnakumbuka overhaul. We also depreciated for overhaul. Overhaul every year, year three, year four, and year five, we have it. So I want you to add the one that we calculated on the machine plus the one for the overhaul. So I want you to add the two depreciation for year three. The one for year three under the machine, overhaul, we also add the one for the overhaul. So confirm to me the depreciation in year three, because now you also include the one for the overhaul. 813, 824, plus the one which was 80,000. So when you add them together, what? Sorry?
893.
893. So all of you online, I hope you understand where I'm getting that figure. Online, are you able to see where you are getting that figure? I hope everybody is able to see. So confirm to me the one for year four. After adding the one for the overhaul, 633, 400. Also the one for year five, you take depreciation on machine plus the one for the overhaul.
455.
455.
976.
976. So now you subtract so that you get the earnings before the tax. So that you get the earnings before the tax. So that you get the earnings before the tax. So to get the earnings before the tax. So what should be that earnings before the tax for year one? Negative 1260. How about year two?
Negative 546.
Negative 546. Year three?
Negative 93, 824.
93.
824.
824. How about year four?
3 316, 600.
316,
600.
which is positive.
Yes.
The next one should be which here? The one for year 5. 6. 644. 024. So that is now our earnings before the tax. So we need now to less the tax. We minus the tax. So tax rate is 30%. So we don't tax a negative here. Yeah. So mnakumbuka hiyo. We don't pay KRA on the loss. We pay them on the profit. So there is no tax in year 1 because it is negative. Also, there is no tax in year 2 because it is negative. Also, there is no tax in year 3 because it is what? Negative. So we start the tax on year 4. 316, 600 multiplied by 30%. Get 30% of that value. 94, 980. How about year 5? $193, 207. So you subtract so that we get earnings after the tax. So that we come up with the earnings after the tax. So this one will just remain negative 1216. This other one is negative 546. This other one is still negative 93, 824. Hii ingine itakuja ngapi?
221, 620.
221, 620. Na hii ingine ya 5,
450.
450,
870.
817 number 70. 817. So now after that, we add back the depreciation. Depreciation is not an actual outflow of cash. It is just a provision to reduce the taxable income. Now, so you add back the depreciation. Add back the depreciation. That depreciation is not a payment. It is simply a provision to reduce the taxable income. It is simply a provision to reduce the taxable income. It is simply a provision to reduce, so that now you get the annual cash inflows. You get the annual cash inflows. So add back a depreciation so that we get now our annual cash inflows. So that we get the annual cash inflows. Yes. If you get 800. So add back a depreciation for each year so that you get now the annual cash inflows. Depreciation is not a payment. It is simply a provision to reduce the taxable income. It is simply a provision to reduce the taxable income.
So not now. We have to get our data.
So after getting those annual cash inflows, we do some other workings also. So we do some other workings. The other working will be to get the present value of the cash outflow. So after that, we also need to do some other workings. We also need to do some other workings. We also need to do some other workings. Also do some other workings. So the other workings, we also need to get the present value of the cash outflows. We also need to get present value of the cash outflows. So to get the present value of the cash outflow, we start with the total initial cost. Total initial cost. Total initial cost, remember it was 5.5 million. Remember how we got that figure? Then we add changes in the working capital. We add changes in working capital. Working capital is the current assets minus the current liabilities. When you go to the second paragraph, they say inventory balances will increase by inventory balances. 1 point. Inventory is the stock. Then debtors will also rise by 1.5. Then creditors 1.2. So what you do, you take the inventory is 1.2 million. You add debtors, it is 1.5. 1.5 million. But you minus the creditors. Creditors, it is 1.7 million. So that will give you the changes in the working capital. So changes in the working capital is 1 million. The other item is the overhaul costs. Overhaul cost will also be part of the present value of the cash outflow. We also add the overhaul cost. But this overhaul cost, you remember it was incurred in which year? End of the second year. Yeah, anything that is not incurred in year 0, you discount. So it was 200 and what? So discount it at the present value interest factor. You discount it at the present value interest factor. In the note number 5, they gave you 13%. It is 13% in year 2. So just take the 240,000, check in the first table. What is 13% in year 2? We discount it because it was incurred at the end of year 2. So confirm in the first table. Confirm in the first table what is there as the first table. 12% in year 3. year 27.
0.797. 0.7972.
There are two tables, so you check the other one, the one for the single period. Is that the case? Yeah, so when you multiply, you are getting how much? So you check 13% in year 2. So mnapata 0.7972 the table. Online, you have seen the figure from the table. So 191, 328. So add them together now to give you the present value for the cash outflows. So I'm going to pay 13%.
Yes, 0.781.
0.7. 0.7831. Yeah, online, you people are just quiet. You are not telling me what figure you are getting from the table. Have you seen the tables? Check the tables. 13% in year 2. Prepare your figures. I'm only doing it at your mercy so that you get to understand how to use those tables. Can you tell me the figure you are seeing in your tables? Hizo table niliprint nikawatumia zingine, the others were typed and were sent to the class group. So get to understand how to use those tables. So online you have seen the figure. Someone has given me 0.7831. So when you multiply that one should give us which value? Ukichukua 240,000 by 0.7831. It's supposed to be 187. 944. So you add them together to give you the present value for the cash outflow. You add them together to give you present value of the cash outflows. So how much should be our present value for the cash outflows? 6 millions.
687.
687.
944.
So that should be now our other working. The other working will be the terminal benefits. We also need to calculate the terminal benefits. We also need to calculate the terminal benefit. Terminal benefit, we start with the salvage value. We start off with salvage one. So salvage value, we remember 800,000. Then you also add changes in the working capital. We also add changes in the working capital. Working capital is treated twice. At the start of the project, it is added on the initial cost when you want to get the present value for the cash outflow. At the end of the project life, it is normally recovered as an inflow. So the same figure you have calculated up there, the 1 million, you add there so that you come up with the total terminal benefits. So you come up with the total terminal benefits. So to get the total terminal benefits. Now, we are ready to get the NPV. We are now ready to come up with the net present value. We are now ready to come up with the net present value. So to calculate the net present value, calculate the net present value, NPV is supposed to be equal to, so there is the year, there is the cash flows, the present value interest factor. It is 13% each year, so that you get the present value. You want to get the net present value. So cash flows are not the same. We need to discount them. It's in the first table. So I want you to go to the cash flow statement. Year one, how much were the cash flows for year one? The 500,000 in the cash flow statement that we prepared in your exercise. It is 500. So year one, we got 500,000. Year two, we got 650. Year three, we got 800. Year four, 855,020. Then year five, multipata ngapi? 906,793. But we now add the terminal benefit. So now your figure to my calculator as the terminal benefit. Tumepata 1 point. Yeah, so you also add the terminal benefit, which is 1.8 million. So that we get the cash flows for year five.
2,706,793.
2,706,793. So online, I hope people are noting that information. So go now to the table. What is the 13% year one? I want you to check in the table, 13% one. 13% in year one. So we are using the first table. What is 13% in year one? You get 0.88. How about year two?
7831.
Year four, year three?
6931.
Year four?
6133.
Year five?
5428.
So now you multiply these figures by these figures of the table, so that you get your present value. So when you will add is when you will get present value for the cash inflows. So can you multiply and add those figures so that you get the totals for that? So how much is this total? 499, 626. Online, are we getting that total? Then now you less present value for the cash outflow. That one we calculated. We got to which figure?
68.
6. 6,687. So that we get the NPV. So we confirm whether it is negative or positive. So obvious our NPV is negative. So we advise them to reject the project because the NPV is negative. So the advice is that reject the project since the NPV is negative. Reject the project since the NPV is negative. So we go to the next question. May 2021, question 4B. May 2021, question number 4, part B. Also check May 2021, question number 4, part B. May 2021, question number 4, part B. We now also check May 2021, question number 4, part B. So that question 4, part B for May 2021. Have we seen the question? So the question reads that Alpha Limited intends to introduce a new product, branded Q, into the market. This will require an initial investment in machinery costing shillings 4.8 million. The machinery will be installed at a cost of 200,000 and estimated to have a useful life of 4 years and a salvage value of how much? 800,000. Additional information, not number 1. Capital allowance will be provided on the machinery on what? So capital allowance will be the depreciation. We said that depreciation is simply a provision which is meant to reduce the taxable income. So that capital allowance will be acting as the item for the depreciation. Not number 2, annual profit from the sale of the product Q will amount to 1920 before deducting depreciation on the machinery. Investment in the working capital of 340,000 will be required on the commencement of the project. The firm pays corporate tax at a rate of 30%. Cost of capital is 15%. That's now the discounting rate. Now required, Roman letter 1, annual depreciation rate. Roman letter 2, the total initial cash outlay. Roman letter 3, the total terminal cash flows. Roman letter 4, the annual net operating cash flows. Roman letter 5, using the net present value approach, advise the management of this company on the suitability or otherwise of the project. So we start with the Roman letter 1. How to calculate the depreciation rate. So depreciation rate this time, it was not given. So to calculate our depreciation rate, when you want to get the depreciation rate, to compute the depreciation rate, it is supposed to be given by, remember, future value is supposed to be the present value 1 plus r raised to the power of negative n. So that's not negative, but just n, because we are looking for the future. The present value is when we put there negative n. So we are looking for the future value. So we want to make R to be the subject, because R is now what will be the depreciation rate. So 1 plus R raised to the power of n will be the same as the future value divided by the present value. And also 1 plus R will be the same as n future value divided by the present value. Then finally, R will simply be n. So future value divided by the present value. We shall be able to subtract 1 at that portion. So R is now what will be our depreciation rate. So one item you need to come up with is that the question had said that they will require an initial investment of 4.8 million. And the machinery will be installed at how much? 200. So our present value, that is the total initial cost. So total initial cost. Total initial cost. Remember, you start with the initial cost, initial investment. You start with initial investment. So initial investment were given for 4.8 million. 4.8 million. You also add installation cost. You also add installation cost. Also add the installation cost. So installation cost was given as how much? 200. That's the same as 0.2. So when you add them, we get 5.0 million. So that is now our present value. So now our R, N is the economic life of the project. The project was supposed to be there for how many years? 4 years. So N will be 4. Future value is the salvage value. Future value is the salvage value. How much was the salvage value? 800. So it will be 800,000 divided by 5 million. Then minus 1. Then
then we shall be required to express that item as a percentage. We shall be required to express that item as a percentage. Online, you try, give me your figure. I want to know how you get it. And also express it as a percentage. Also express it as a percentage. You are getting which percent when you express it as a percentage. Online, give me the figure. What are you getting as that item for R? Someone has gotten 60%. Anyone else who has calculated? Online, I want your contribution. Watu wanapata 60%. Nasema mnapata ngapi? Yeah, online mkinyamaza kaeni na shida zenu. I will not bother. Because if you calculate, you give me your figure, I know where you go wrong and I will assist. But if you keep quiet, then you just stay with your problems. Yeah. You are to a class wamepata na nyinyi hamtaki kuniambia. Sasa tutawapea tu figure. Then we proceed. So mmesema ni 30 what? 36 point. Yeah, I will also do the same. When you keep quiet, I also just keep quiet and do what? Move. Because you don't want to interact. So only 2 people have given me 60%, and 60% is very wrong. So others, what figures are you getting? If you don't get it right, you forget all the marks in that question, because it will not give you any value there. If you don't get the depreciation rate correctly, it will disappear. You will not get any other marks from there. So all of you, only 2 people have given me 60%, and 60% is wrong. So others, you are getting which figure? I've seen 36.75. So is there anyone with a problem who is not able to get 36.75? Because you want me to ask you in that perspective. So do we move on? So I assume everyone is okay. So you have gotten 36 points? Yeah, so let us just move on. Because people are just silent. And I've been told it is 36.75%. Yeah, how did you get it? When I'm asking, they are just quiet. Now they are asking me, how do we get the value? So when you go to your calculator, in your calculator, I want you to start with this figure. 800,000 divided by
5 million, isn't it? So then you are pressing which side after that? Yeah, so once you have taken this divide by that and you have gotten the answer, you press 4, then you press shift. Is it 4 first or more shift first? So you press 4, then you press shift, then you get the answer. Once you get the answer, you subtract 1, then multiply by 100 and see whether you get 36.75. Is it okay up to that point? Someone who said, how do we get the figure? Have you gotten that value? Have you gotten 36.75? I'm only teaching 2 people online. The rest, wamenyamaza tu. The beauty is, if you don't participate and see how we got the figure, when you will go to revise, you will be spending hours to see how to get that small figure. So that is now our depreciation rate. That's now meant to be our depreciation rate. So once we get the depreciation rate, we go to the Roman letter 2 of the question. We go to the Roman letter 2 of the question. So Roman letter 2, they wanted you to get the total initial cash outlay. They wanted you to get the total initial cash outlay. Total initial cash outlay. So Roman letter 2, they like you to get the total initial cash outlay. The total initial cash outlay. So that total initial cash outlay is the same as present value for the cash outflow. It's the same as present value for the cash outflow. So we had already computed the initial cost. We had already calculated the initial investment. Initial investment. Got 5 million. Got the 5 million. Remember 4.8 plus 0.2? Yes. But now we also add there the changes in the working capital. We also add on that figure. Add on the value changes on the working capital. So changes in the working capital is given to you in the note number 3. Note 3, they say that an investment in the working capital amounting to 340. 340, you add to be able to give you the total figure. That is now the changes in the working capital. Then now when you add, so that is our Roman letter 2, total initial cash outlay. We go to Roman letter 3, the total terminal cash flows. Roman letter 3, they would like you to get the total terminal cash flows. The total terminal cash flows. So to get the total terminal cash flows, remember we start with the salvage value. We start off with the salvage value. So salvage value, remember 800,000. Remember the 800,000. Then we are required to add. We are required to add changes in the working capital. We add there the changes in the working capital, which was 340,000. So when you add them together, that now gives us the total terminal cash flows. Be able to give you the total terminal cash flows. That's now our Roman letter 3 of the question, how to come up with. So we go to the Roman letter 4. Roman letter 4, they would like you to calculate the annual net operating cash flows. But before we do that, we should calculate the depreciation. We should calculate the depreciation or the capital allowances. We compute the depreciation or simply the capital allowances. We now calculate depreciation or the capital allowances. So to get the depreciation or capital allowance, we are using the reducing balance basis. Depreciation or the capital allowance, we are using the reducing balance. So we start with the initial investment. We start off with the initial investment, which was 5 million. We don't depreciate the working capital. We only depreciate the initial cost or initial investment. So we less depreciation for year 1. We minus depreciation for year 1. So we calculated the depreciation rate, which was 36 points. So get 36.75 of the 5 million. We get 36.75 of the 5 millions. $18,37,500. So subtract to get the net book value at the start of year 2. Net book value at the start. At the start of year 2. So what will be the net book value at the start of year 2? 3,162,500. So also less the depreciation for year 2. Depreciation for year 2 is also 36.75%. 3,162,500. 1162.
218.75.
When you round off,
Yeah, 218.
so that we come up with the net book value at the start. At the start of year 3. So what should be the net book value at the start of year 3? What should be the net book value at the start of year 3? 2 millions.
281.
281.
2,281.
Sorry.
2,281.
2,000.
No, the
2 million.
0,0,0,281.
Like that.
Yes.
So now we less depreciation for year 3, where you also get 36.75%. 2 millions. 735.
103.
103. So that you get the net book value at the start of
Year 4. How much is the net book value at the start of year 4?
1,265,178.
1,265,178.
265, 178.
Then we say that for the last year we don't compute depreciation. So depreciation for year 4 should be the balance figure so that we get the salvage value. Should be the balance figure so that we get the salvage value. So salvage value, the question had given us which figure? 800. So what should be that?
465, 178.
465. 178. So that is now what we need to do to get the depreciation. After we have calculated the depreciation, we want to get the annual cash inflows. We want to get, so this time I'm not using a cash flow statement because the question has already given us earnings before depreciation and the tax. So to get the annual cash inflows, so we are answering the Roman letter 3. So to get the annual cash inflows, annual cash inflows, it will be given by earnings before depreciation and the tax. Then 1 minus the corporate tax. Then we add depreciation multiplied by the tax rate. So when you want to calculate annual cash inflows, it is earnings before depreciation and the tax. Then 1 minus the corporate tax. Then depreciation. Remember that formula? Yeah, so the question I'm using it because in the note number 2, they had given you the profit before deducting what? Depreciation every year. So you start off with the year 1. We start off with year 1. So year 1, you simply take the 1920. That figure is given to you in the note number 2. So that is earnings before. So 1 minus the corporate tax like that. So we already have depreciation for year 1. Remember 1,837,500. So multiply by 0.3. That will give you the annual cash flows for year 1. That should be able to give you the annual cash flows for year 1. It will give you the annual cash flows for year 1. Then come year 2. When you are in year 2, we do the same. Year 2, we also do the same. It's 1920. 1 minus 0.3. So depreciation for year 2, it was 1,162,219. Also multiplied 0.3. Also multiplied by 0.3. So that is what you are able to get. Then you also go to year 3. Also go to year 3. So for year 3, it is also 1920. 1 minus 0.3. So depreciation for year 3 was 735. 103 multiplied by 0.3. Also do the same for year 4. Year 4 also get 1920. 1 minus 0.3. So
you also take 465,178 multiplied by 0.3. So that is now your Roman letter 4, where you get the annual net operating cash flows for each year. That is now our Roman letter 4, how to calculate the annual net operating cash flows for each year. The annual net operating cash flows for each year. That is meant to be your step, your Roman letter 4 of the question. So that is now our Roman letter 4. We got the Roman letter 5, whereby they were saying that using now the NPV approach, advise the company on whether to proceed. So we now calculate the NPV. We should now be able to compute the NPV. We should now be in a position to calculate the NPV. Should now be able to compute. So NPV is supposed to be given by NPV should be present value for the cash inputs minus present value for the cash outputs. So there is the year, there is cash flows, then present value interest factor. This time round, cost of capital in the note number 5 is 15%. So 15% each year, so that you will get the present value. So we start off with year 1. How much cash flows are you getting for year 1?
1895 to
1895 250. All of us were getting that figure. Nilipata ngapi? Sorry?
Yes.
1895 to 50.
Yes.
Online, you are getting that. You got that figure. How about year 2? Year 2 ilikuwa ngapi?
1692 6.
Year 3. 1564. So year 4 mlipata ngapi?
1483.
1483. Then tuna add, nakumbuka terminal benefit. We calculated in the Roman letter 3 total terminal cash flows. It was how much?
1140.
Sorry?
1140 now.
Online, I want you people to confirm to me those figures. Are they correct? Online, mniambie kama those figures are correct. This 1 minus 0.3. Just multiply 0.7 to have it taxed. Online or nakataa kuongea. So what figure is there in the table? So get the values in the table, 15% like that. When you add, you get the present value for the cash inflows. Anasema ya 3 ni ngapi? 15 what? 1564. 1564. 531. 31. So you will less present value for the cash outflow. Present value for the cash outflow. You remember what we calculated as the total cash outflow. So we got 5 million 5340. When you subtract, you will get the NPV. So if it will be positive, you advise them to accept the project. If it is negative, you advise them to reject. But you will check 15%, year 1, year 2, year 3, and year 4 in the table. Like that. So we stop there. When we meet now, I will give you the advantages of the NPV. When we meet, I will give you the advantages of NPV so that we go to the next method. So we can stop there for now.